Hello, hello, welcome back. Well. Cathie Wood is investing in General Motors. I thought she was mostly about innovation and not these kind of old companies, right? Okay, let's take a look at what happened here with Cathie Wood. ARK Invest, she buys General Motors for the first time, snapping up 6 million in shares in a change of heart, was what the article mentions here. So she actually bought 158,000 shares in General Motors, and it marks a change of heart for Cathie Wood, who has said legacy automakers don't have the DNA for innovation. So what are we going to expect next from her? Is she gonna be buying even larger dinosaurs? I don't know. Is she going like General Electric or something of that sort? So that's a very interesting push over here. And so yeah, she snapped General Motors for her ARKQ exchange traded fund that you will see here, and we'll see what she's going to do with this one after investing in companies like Tesla, Zoom, all these pretty much companies that are very supposedly innovative, yet they are not making money. I mean, some of them are, but some of them are not. And so, she does have some nice companies, but also some other ones that are insane in terms of what they're doing financially and what their actual stock price was. Very overvalued. And now it looks like she's becoming a little bit of a more cautious investor. It looks like maybe she even read the Intelligent Investor book. Who knows? So we're gonna take a look at the actual stock, General Motors. Now, General Motors is a company that has actually defaulted in the past, and they have actually bankrupted. And so this is a thing that I, generally speaking, hate about companies. I don't like investing in companies that have absolutely decimated their previous investors. And so for whichever reason, it doesn't really matter to me. Because when a company is actually allowing themselves to go bankrupt and then reform under the same name pretty much, they are screwing investors. And so if they did it once, why not do it again? And so this is something that I really don't like to see. And in case you are not aware of what happened, let me actually find an article to show you when General Motors got bust. So you can kind of see it here. On June 2009, General Motors filed for bankruptcy in New York with 82 billion in assets and 173 in liabilities, the largest industrial bankruptcy in history, as you can see. And so yeah, they pretty much reorganized as a new company, and the people who owned shares back then, they got completely annihilated. They basically owned zero. Now I don't know if they went through some sort of arrangement in terms of getting some extra shares. I'm not sure about this one, because sometimes when there is a bankruptcy, you may get some options or something of that sort if you're a previous investor. But typically you see investors losing all their money. And so when that happens, again, I'm really not a fan about companies who do that, regardless of the reason why they did that. I don't really examine the reason. And so that alone would potentially deter me from actually investing in General Motors. I myself, I wouldn't invest. There's no way. But maybe somebody else is thinking about it. And so let's take a look at the company in case some do. You will see here that the company has been again in a downturn. I mean, you could kind of expect that. Doesn't mean that the company is bad. A lot of stocks, a lot of companies have been battered down. We need to examine the financials and not just take a look at the chart or the stock price. That's not enough. So let's take a look. PE ratio. This is actually fairly low here. 6% is actually very low. 6, not 6%. So 6.08. And the price to free cash flow though is negative, so that's very interesting. Companies actually having a negative price to free cash flow, but very low and positive price to earnings. So we're going to examine the details about this one. Outstanding shares, they are about the same. Free cash flow, we examine that it is negative. We will see why it is negative, though. That's very important. Revenue growth is basically at the same place and a little bit lower than what it used to be before. It's a massive company. You can't expect them to increase the revenue every year. That's not going to happen. No way. And 5-year net income growth has been increasing. This is very interesting to see cash flow going down and net income going up. Very interesting. We're going to examine why this is happening. And debt to equity ratio, the company has a little bit of debt. They probably utilize it to get better return on equity, because this is affected by debt. And let's see, actually, things are looking relatively fine. A little bit of a low margin here. But let's take a little bit of a closer look at the financial statements. I'm interested, actually, curious to see what's going on with the cash flow. Revenue has been dropping a little bit, but again, that can happen with behemoths. And look at this net income has been growing higher and higher here. So the company is making some good money. So what's going on with the free cash flow? I'm assuming this has to do with capital expenditures, but we'll see. Let's take a little bit of a closer look at the balance sheet first. So interesting to see here. Let's take a look at the total equity. 36 billion to 65 billion, so this gets increased, so that's good to see. And what we do want to examine is the cash flow statement, because that's super interesting. Again, remember the net income was positive and getting more and more positive here. So why is that the cash flow, the free cash flow is negative? We'll see. 15.19 billion is what they last did in operating activities cash flow. Investing cash flow has been negative, which is good. The company has been investing in themselves. In terms of financing activities, you will see that the company is getting a little bit of debt over here. So you would kind of expect that. That's not a huge deal, especially when you actually correlate it to what the company has been making. But the cash also has been increasing. The cash at the end of the period was 23.54 billion for 2021, that is. And look at the free cash flow. Now that's interesting. From minus 10 billion to minus 6.9 billion over here. What's going on over here? So remember, free cash flow is operating cash flow minus capital expenditures. And so you will see here that the capital expenditures of the company are insane. General Motors has very, very high capital expenditures, and they're spending pretty much the same every year. So this looks like they are pretty much steady expenditures, and that is a big, big problem, because they are spending all their cash flow and then some to capital expenditures here, and that is pretty worrying. And again, this is the same. It's not like a one-off. Every year it's about the same thing. So they either have to increase their net income or cash provided by operating activities substantially, or reduce the capital expenditure substantially, which may not be easy to do, actually. So this is concerning, and we're going to take a look at the stock evaluation tool, see what's going on there. Looks like Cathie loves these companies that don't make any cash flow. Let's see. So the company has been pretty much negative in terms of revenue growth, as you'll see. If you average it out, you will see that it has been like minus 5%, minus 4%, and 3% like last year. So we're gonna go super low here. We're gonna go 0, 1, and 2%. Very, very low in terms of growth. Basically assuming that the company could actually not grow at all, or very little. Net income margin that we're going to be using, again, this one is a little bit positive, is good to see. So we're gonna go maybe for 6 and let's take 8 here as well, which is close to this, what happened last year. And the free cash flow margin, remember, free cash flow is the company's problem here, because they are not making positive free cash flow. We will assume that at some point they will reverse the situation, but this is a very, very big leap of faith. And it's very problematic that the company has such insane capital expenditures. So typically we will want to make something like 70, 80 or 90% of our net income as free cash flow. And 13% is what we want to be gaining out of every single stock. And if we do the calculation here, you will see that under these assumptions, we can potentially buy the company. It looks like it could be a buy. Yet remember that our free cash flow margin is much, much lower. And so this will have to be positive, and very, very positive compared to the net income that the company is generating. This is not the case. We are mostly looking to get something like this to begin with, because so far all these values have been negative. And this is the only positive one, but if you take a look at it, you will see that net income and free cash flow has been negative. So this is one that you can basically exclude from your calculations. These are the actual values here, and they don't make a ton of sense. And so if you use 10, 20, and 30%, now you're getting much, much less free cash flow compared to net income, which is the actual story. And in this situation, this is not a buy. And remember, this is also aggressive. This is not happening right now. So as I'm seeing the company, it looks like they are generating some net income, yet not any cash flow. And I hate that. That's something that I just can't see myself getting into. Not to mention that the company has also bankrupted in the past. I just don't like seeing something of that sort. So yeah, I'd love to see the company make some steady cash flow and not pretty much lose cash flow every year, free cash flow. And yeah, we can see how they're gonna be doing in the next few years. But Cathie Wood, it looks like she really enjoys these companies that are doing terribly financially. Who knows? So thank you for watching the video. I hope you enjoyed. Let me know what you think about General Motors. And thank you for watching this one. I'll see you in the next one. In the meantime, take a look at this video that I made about Palantir, an interesting company. See how it's doing these days. Thank you for watching. I'll see you soon. Bye bye.